This is Taking Stock on Bloomberg. I'm Pim Fox. What a difference a year makes. Oil was almost $150 a barrel, well, this time last year, after reaching $147.27 a barrel 1 year ago. Oil now below $60 today, falling more than 10% this week alone. Natural gas futures down 75% from their July 2008 highs. And Jason Gamble is an expert in all things oil and natural gas at Macquarie Securities. Jason, good to have you with us.
Thanks for having me, Pam.
Really, what a difference a year makes. I mean, is this, well, let's go back. Was that $147 print, was that an anomaly, or are we going to see that again, do you think?
I think we're going to see it again. I think it's going to take a while. I think when you saw the price rise last year, there were some very severe dislocations in particularly the diesel market, and diesel pulled crude oil prices up along with it. Those situations corrected in the summer, and so the decline was something that was to be expected, maybe not to the magnitude that we have, but I suppose when you go into decline and then you have an unprecedented financial situation to go along with it, you hit some pretty low prices.
Yeah, that kind of can make things very messy.
Yeah, it certainly can. But I think, and that's continuing to play out. We have still very weak demand for refined products in general, but I think what we're going to see happening over the course of the next 2 years is that the lack of investment in upstream production capacity that has come from a pullback in oil prices is going to lead to ever-declining production capacity, and especially in non-OPEC areas. And if you get any type of economic recovery, I think you're back into a situation where you get to scarcity pricing again, 2012, 2013, somewhere in that time frame.
So anytime someone says, oh, don't worry about the price of oil, we've got all this spare capacity, it's always good to remind them that spare capacity can go away very quickly.
Absolutely. That spare capacity exists at the pleasure of those who invest.
When we were listening to Peter Buttel of Cameron Hanover talk about the U.S. dollar and the strength or the weakness of the dollar and how that affects oil prices, just to recap, what does the dollar value mean for oil prices?
Historically, it hasn't really meant anything. There hasn't necessarily been a very strong correlation between the two. But I think what you've essentially had over the last year and a half or so is oil serving as the role that gold did for a long period of time. It's a way of storing physical value in a product that is going to attract a reasonable price over a long period of time. So you have seen a very strong inverse correlation between the move in the dollar, particularly against the euro, and the move in oil prices. And, you know, we really think that was very supportive of the move that we saw in June, that it was largely a foreign exchange and inflation hedge type of trade that was going on.
Okay, now I was leading you down there anyway because I wanted to get you to talk about foreign exchange, because in a recent note that you just wrote about Chevron, foreign exchange was a big component about what's going on at Chevron. And you give us the details.
Well, the company released an interim update on what the second quarter was going to look like on Thursday night. And I was expecting a very robust earnings period from the second quarter because oil prices had risen to such a large degree. What kind of caught us by surprise is that the fall in the U.S. dollar that was occurring over that same time frame had caused the company to incur a major foreign exchange loss in the order of magnitude of $400 million. And that's essentially reflecting costs that are being translated over for some of the places that they operate in, revaluing balance sheet items, et cetera. So, you know, it was a big hit on the cost side that we really hadn't anticipated.
All right, but that has not shaken your faith in Chevron, right?
No, it's a one-quarter event. I mean, I'm not necessarily thrilled about it, but it doesn't really change the overall investment thesis. We're talking about dimes here, and what we see are tens of dollars in the stock price that it will still appreciate to. Stock's at about 60 right now. I think if you want to assume a long-term price of $60 oil, this stock is worth at least $84.
All right, let's do a little detail on Chevron upstream right now. What's going on in the upstream with Chevron?
Production volumes look great. I think that Chevron is in a position this year to grow their production by 5 or 6%. If they do so, they'll be by far the biggest grower in the integrated space. They'll probably surpass most of the large cap E&P companies on growth rate as well. So very strong in that regard. They've got a lot of major projects starting up. Deepwater Gulf of Mexico projects are really driving the growth this year, as well as some things they're doing in Kazakhstan. The upstream performance has been very strong. Unfortunately, it hasn't translated into financial performance in the second quarter, at least. That will all change moving forward. I think the financials will follow along with the production results.
Why is it so hard, seemingly, to get investors excited about big integrated oil companies? I mean, or maybe that's not true, but I mean, it seems as though that it's just really tough to get people to sort of get excited about ExxonMobil or Chevron or any of these big integrated companies. What's the story?
Well, when people are chasing movements in commodity prices through the equity markets, they're really going to gravitate more towards those companies who have big earnings momentum that are caused by the commodity price changes. And really, it's E&P companies and oil field service companies that attract the money that is looking for those big moves. What you tend to find in the integrated stocks is the value investor, the large cap portfolio that's being managed that needs to have some exposure to energy. And then it can also be used as a defensive positioning if investors are expecting oil prices to go down, because the integrated companies will tend to be a lot more stable. Now, I think we're actually in a period where that's going to come into the forefront again. I think that we're going to see relatively weak oil prices over the back half of 2009. And as a result, I think the integrated stocks are going to be a good place to be.
All right, because they're going to provide perhaps that kind of stability.
Protection.
What about the downstream operations at Chevron?
Downstream in general is horrendous right now.
It's lousy, right?
It's absolutely horrendous. And I cannot paint you a scenario, barring hurricanes wiping out Gulf of Mexico coast production, or excuse me, refining capacity, that leads to a strong refining margin environment over the next 2 years. Demand is terrible. We have to blend ever more ethanol into the gasoline pool. You are seeing
you got a lot of supply.
You've got a lot of supply,
that, right?
And then you get into some intricacy things, like the fact that it costs just as much to buy a barrel of heavy oil as light, and so many companies have invested in being able to crack those usually less expensive heavy barrels. So it's just a really tough.
It sounded like a great idea at the time, but right now it's not looking out to be
too
such
many
a
people
good
did
bet.
it.
Too many people
it was too
did
good
it.
of an idea.
All right.